Indian chemical sector has seen a roller coaster ride in last few years. Before COVID bull run, nobody really discussed chemical stocks. But during COVID bull run, many chemical stocks generated huge multi-bagger returns and chemical sector became the hot favorite of investors. And then we saw a big slump. In the last 1.5 years, chemical companies have seen deep correction and majority of them are down between 40 to 60%. Unfortunately, majority of retail investors ended up investing during the bull run and currently on loss. This deep correction has triggered many important questions. What really went wrong with chemical stocks? Is the future of Indian chemical sector still bright? If yes, is it a good time to buy chemical stocks? And if yes, which stock should you pick? Hey everyone, my name is Sahil and this is my Personal Finance Academy. In 2021, Indian chemical sector has seen one of the biggest bull rally and many stocks generated huge multi-bagger returns. One of the biggest reasons was China plus one theme. China is the largest chemical manufacturing hub in the world. But in the last few years, Chinese government banned many chemical factories in China due to environmental concern. And that created huge shift in demand to countries other than China. There are two more factors pushing China plus one theme. First is US-China trade war. Due to ongoing trade war between US and China, many US companies want to reduce their dependency from China. And second, recent global supply chain disruption during COVID has also pushed the demand for additional sourcing destination other than China. As a result, Indian chemical companies witnessed huge demand and their profits zoomed exponentially. Since 2021 was the bull period, huge profits resulted in crazy demand for chemical shares and hence chemical stocks zoomed exponentially. But over the last 1.5 years, we have seen deep correction in Indian chemical sector. Now there are three major reasons for this deep correction in chemical sector. First is slowdown in demand. During COVID, there was a sharp jump in demand for Indian chemical companies due to supply chain disruption from China and shutdown of many chemical factories. This resulted in sharp jump in revenue growth. However, that growth has now slowed down due to slowdown in global demand, especially from US and Europe. Second factor is sharp jump in raw material cost. During COVID, the margins of chemical companies jumped crazily due to low raw material cost and of course the high demand. However, now that we have global inflation problem, the raw material cost has significantly increased. On top of that, Russia-Ukraine war resulted in crazy jump in gas prices that resulted in high cost and low margin. Hence, the profits of chemical companies tanked after sharp jump post-COVID. And third factor is liquidity crunch. 2021 was the year of crazy liquidity and hence chemical stock valuation zoomed exponentially. And now due to rising interest rates, the liquidity has been sucked out and chemical companies' stock valuation have corrected significantly. Since chemical stock generated huge return in 2021 bull run, they saw profit booking and hence the shares have tanked badly. And the sharp correction in chemical stocks have really created panic among investors. To be really honest, it is not easy to gather confidence when the stock tanked 50-60%. The question is, what is the future of Indian chemical companies? Was China plus one theme a fad? Now, should you sell chemical stocks at loss or is it time to accumulate chemical stocks? So I wanted to discuss this topic in depth and hence I have created two videos on this topic. This is the first part of the video where I have discussed the future of Indian chemical sector. In that, I have discussed a very interesting report from Mckinsey that has come up with a detailed analysis on Indian chemical sector. And in second part, I have covered the top chemical companies to consider investing your money. First of all, let me discuss the future of Indian chemical sector. So China plus one theme is not a fad. Let me be very clear on this. There is a structural shift in global MNCs moving away from China for chemical manufacturing and India has really emerged as one of the top alternatives. Let me quantify this opportunity in terms of numbers that would give you a clear picture. In one of the articles, Indian Chemical Council President mentioned that the total value of Chinese chemical market is around $1,500 billion, whereas Indian chemical market is around just $150 billion. So Chinese chemical market size is nearly 10 times the Indian chemical market size. So if just 10% of Chinese market shifts to India, it would double the size of Indian chemical market. And that is the expectation. In the next 4 to 5 years, Indian chemical sector can get additional $150 to $200 billion worth of investment. The question is, why India can be a great alternative to China? The answer lies in Indian chemical ecosystem. India has a fantastic ecosystem that supports chemical manufacturing, including required labor at very low cost, required resources like your land, water, electricity, etc. again at a very reasonable cost. Then Indian chemical sector is very mature with decades of experience, and one of the biggest factor is growing internal consumption. Indian consumption sector is growing exponentially, and that is creating immense demand for chemical consumption internally. Now recently Mckinsey has come up with an interesting report that titles India the next chemical manufacturing hub. In that report, it mentioned that chemical sector in India is projected to grow by 11 to 12% during 21 to 27 and by 7 to 10% during 27 to 40, tripling its global market share by 2040. This growth is expected to be driven by multiple factors. First factor is rising domestic consumption. India is expected to account for more than 20% of incremental global consumption of chemicals over the next 2 decades. Domestic demand is expected to rise from $170 to $180 billion in 2021 to $850 to $1,000 billion by 2040. So you can imagine how crazy this demand is. Second factor is changing consumer preference. The growing demand for bio-friendly products globally could benefit India, as India is among the leading producer of many chemicals that are used in such products. Third factor is shifting supply chains. Triggered by the evolving geopolitical scenario and the trend to diversify from existing core manufacturing market, firms are seeking to make the supply chain more resilient. With its strong value proposition, India could be a preferred destination. Mckinsey even compared Indian chemical industry against the 6 global chemical manufacturers: China, Germany, Indonesia, Saudi Arabia, South Korea, and Vietnam on 26 different parameters, and Indian chemical sector was either leading or competitive on most criteria. For instance, it has used 3 factors: whether India is lagging, comparable, or leading against the benchmark countries. If you look at labor and utilities, India is leading in terms of average hourly wage. In fact, it's number 1 in terms of lowest manufacturing labor wages in the world. Then India is leading in workforce availability. Again, India has highest workforce availability after China. Then comparable on industrial water use cost and electricity cost, although it lags in terms of availability of R&D talent and domestic availability of petrochemical. Then it is leading in terms of construction cost, material cost, machinery cost, EBITDA per unit of investment, comparable in terms of interest rates and corporate tax. Then in terms of ease of doing business, it is leading in terms of protecting minority investors, getting electricity and credit, etc. Then comparable in terms of resolving insolvency and trading across border, but lagging on registering property and land, paying taxes, starting a business and enforcing contracts, and also lags on obtaining environmental clearance. So overall, India is looking very promising and leading on majority of key parameters. Within chemical sector, as per McKinsey, specialty chemical sector is the strongest pillar. Within specialty segment, some of the key sectors are agrochemical, flavors and fragrances, food and feed additive, and nutraceutical. Then within inorganic chemical, McKinsey mentioned that fluorine segment is growing at 10% CAGR rate. It is driven by high demand from pharma and agro sector. Then there is also demand of sodium and caustic. So overall, this report from McKinsey is very encouraging for Indian chemical sector and instill confidence to invest in Indian chemical sector. In fact, even Indian chemical companies know that there is immense growth opportunity, and hence majority of them are investing in capex in building capability to meet this incremental demand in near to long term. So one thing is very clear: China plus one theme is not just a fad. It is a strong structural shift that is going to immensely benefit Indian chemical companies. The biggest factor is shutdown of chemical factories in China and global MNCs reducing their dependency on China and creating supply chain alternatives out of China. And that's where India has emerged as a top alternative due to its highest workforce availability at one of the lowest labor costs. Then moreover, India is also leading on various other parameters like availability of resources including your electricity, water, land at very competitive rate. And India is also leading with one of the lowest infrastructure setup costs including your machinery, construction, etc. Yes, there are certain challenges including unavailability of R&D talent, but overall India is leading or competitive on majority of criteria. So there is no need to panic. In fact, this recent correction in Indian chemical market has made chemical stocks very attractive and has created a good opportunity to accumulate them. Now, I don't want to stress this video further. In the next video, I'll discuss some of the top chemical companies that can potentially benefit from this high growth opportunity in Indian chemical sector. Now, if you agree with my viewpoint, give this video a thumbs up, or if you disagree, I would love to hear your thoughts. Put them in the comments. I hope you'll find this video useful. I'll see you in the next video of top chemical stocks. Till then, take care.